Hi, this is Brian with the Retirement Network, where we try to reach client goals with the least amount of risk possible. Today, we're starting our Fundamental Investors series, beginning with stocks and bonds. You're going to see my screen. I'm going to roll through some items, and we're going to try and keep this as quick and short as possible. All right, stocks and bonds. Stocks represent ownership in a company or a share of the company, so that's why stocks are sometimes referred to as shares. Conversely, bonds are a loan, and that's why they are sometimes referred to as debt. Now, to begin understanding stocks and bonds, I always like to start with the business owner's point of view first. From a business owner's point of view, when you issue stock, this is a way to raise money to expand your business, and you forego some ownership in order to do that. From the bond side of the fence, issuing bonds is a way to raise money without giving up ownership, but you take on debt in order to do that. Now, from an investor point of view, stocks are a good way to own a piece of a company as an investor. Bonds, as an investor, are a way to get paid back on money loaned. Stocks are considered to be riskier than bonds because if a company goes into bankruptcy, shares become worthless. On the bond side of the fence, bonds are considered safer than stocks because in bankruptcy, a company must pay back their debts first. Now, there's a widely used analogy to explain stocks and bonds and just businesses in general, and that's the lemonade stands. And I'm going to use that because it does work pretty well. So let's imagine your kid has a lemonade stand, and he is doing so well that the neighborhood cannot get enough of his lemonade. He thinks he can make a lot of money if he expands the business, but he doesn't have enough money to expand it enough. So what are his options? He can issue stock to raise money, and he would have to give up some ownership to those people that give him money to buy the stock or shares of the company. He can also issue bonds if he doesn't want to give up ownership, but he takes on debt to do that. Now, as you can imagine, this riskiness in terms of stocks versus bonds shows up in the stock and bond markets, and that's depicted in this next slide. In this slide, you can see this blue line that's pretty volatile. That is the S&P 500, which are the top 500 United States stocks in terms of size. The yellow line is the U.S. bond market. Now, here's 2008, of course, where bonds did a lot better than stocks, but you can see over time that stocks outperform bonds by quite a large margin. That volatility that we see here, that is the price we pay for ownership of a company. That more potential return than bonds is a part of ownership. It is also the risk of having ownership in a company. So the bottom line is stocks are ownership in a company, bonds are a loan to a company. Okay, that's it for today. Remember, at the Retirement Network, we try to reach client goals with the least amount of risk possible. Stay tuned for our next Fundamental Investor series. We'll see you then.